Welcome back to Federal Tax Preparation. This is Lesson 3, and in here we have 4 defined learning objectives. The first is to define the dividend received deduction, DRD, which we'll refer to later on in this video. Second is to illustrate the dividend received deduction calculation formula. Third, understand the formula of charitable contribution deductions. And number 4, describe the treatment of organizational expenditures. Lesson 3 requires 3 pages of reading. Page 10 will read other expenses, and we'll take a brief look at that momentarily. Then we'll read M1 adjustment on page 11. The M1 refers to the tax return form M1, and the M2 adjustment on page 14. And these are reconciliations that the federal government requires of corporations as they keep their books. Finally, the activities. We have 4 discussion questions, which we will pick up at the end of this video. On to page 10. Here we deal with capital losses, and there's a distinction made immediately between the individual and the corporate. Then we look at some of the items that are included: compensation, payroll, vacation, bonus, employee benefits, life insurance proceeds and premiums. Life insurance proceeds and premiums are quite interesting because they are tax-free due to a very, very early legislation. It allows them to provide investments for those who are putting up money for the insurance company that are literally tax-free. So one can avoid income taxes in certain instances that would otherwise be payable in something like a personal savings plan. We look at bad debt expenses in here, also taxes, state and taxes that are deductible. We look at interest expenses, business gifts, meals and entertainment. These have always been a mainstay of the traveling salesman because 50% of those expenses can be deducted, meaning the entire cost of your guest you pay for yourself. Political contributions by corporations are not deductible. Research and development under certain conditions are, and intangible assets, goodwill, trademarks, patents, covenants, licenses, amortization under certain circumstances can be tax exempt or have tax favored treatment. We now look at page 11 for our second topic, and here we have the M1, M2 reconciliation adjustments, where we reconcile the books to tax amounts before net operating loss. These are temporary and permanent differences. Under the generally accepted accounting practices, we have a column of temporary differences, estimated warranties, unearned rent, and then we have permanent differences. The several are offered here: state municipal bond interest income, penalties, fines, life insurance premiums and expenses, federal tax expenses, and dividends received deduction. The M1 formula basically takes book income and takes into account taxable income before net operating loss, or DRD. Income tax is taxable but not recorded to book in a number of instances. They give expenses here, which are rather lengthy. We'll cover those in class. Next, we have an example on page 12 of the calculation done for this adjustment, and at the bottom of page 12 it gives a schedule of M1 reconciliation of income items. And again, this is all part of the example, so these are actual numerical amounts as a sample problem for you to examine. We turn to page 13, continuing this topic from page 10, from 11 and 12. We have an actual picture here of the M1 schedule and the M2 schedule. There is also an M3, and under certain circumstances, the M3 may be required. It gives greater detail than these do, and it would be probably applicable to larger corporations. Excuse me. Finally, page 14, the last page of your reading, we have the analysis of unappropriated retained earnings per book. The beginning retained earnings, we add net income after tax, add other increases or period adjustments, we subtract other decreases, and we subtract distributions as in the form of cash, stock, or property. Schedule M1 and M3 are again reconcile issues between book and tax differences on either the Schedule M1 or the Schedule M3. And this determination, of course, is based on the assets of the company. It does not list it as 10 million or greater per year. The company must fill out the M3. Finally, the M3 breaks out book items and expenses in greater detail, as well as distinguishes between permanent and temporary differences. Finally, we come to our Lesson 3 activities, and for this we have 4 discussion questions and, of course, the online quiz. Discussion question number 1, and these relate directly back to the learning objectives. Number 1, discuss the minimum stock holding period to claim the dividend received deduction. Recollection is it's 6 months, but don't use that, look it up. Discuss how stock ownership percentages limit the allowable DRD rate. We're looking here for an avoidance of triple taxation is the idea behind this dividends received deduction, because the stock is already being taxed as it's earned by the corporation, paid by the dividend, and now if that becomes income for another corporation, it's getting taxed a third time. So this is the reason for that. Discuss how stock ownership percentage is limited. Number 2, we did that. Number 3, discuss the treatment of research and development expenditures of corporations under 3 alternatives. I don't see the 3 alternatives in the text immediately, but I presume it is there in some form, so if you page ahead a little bit, you may well come across those 3 alternative scenarios for research and development deductions. For some companies, these can be a substantial part of the overall activity of the company, as, for example, an aerospace military contractor or a licensed drug manufacturer. And then, last of all, discussion number 4, tax deduction, the rule for organized expenditures, OE, and we'll discuss that also briefly in class to give you an idea what we're talking about there. Very good job on the discussion questions to date. We expect to have a similar workload each week, with the exception of last week. Congratulations on having an easy week. This one gets back a little bit more to the regular pace. Thanks, and we'll see you in class.